Real-time real estate segment today being brought to you by rsrmoney.com, rsrmoney.com. Two of the factors that impact mortgage rates. If you're looking to buy a home, you've probably been paying close attention to mortgage rates. Over the last couple of years, they hit record lows, rose dramatically, and are now backing down a bit. Ever wonder why? The answer is complicated because there's a lot that can influence mortgage rates. Here are just a few of the most impactful factors at play. Inflation and the Federal Reserve. The Federal Reserve, the Fed, does not directly determine mortgage rates. But the Fed does move the federal funds rate up or down in response to what's happening with inflation, the economy, employment rates, and more. As it happens, mortgage rates tend to respond. Business Insider explains, quote, the Federal Reserve slows inflation by raising the Fed funds rate, which can indirectly impact mortgages. High inflation and investor expectations of more Fed rate hikes can push mortgage rates up. If investors believe the Fed may cut rates and inflation is decelerating, mortgage rates will typically trend down, unquote. Over the last couple of years, the Fed raised the federal fund rate to try to fight inflation, and as that happened, mortgage rates jumped up. Fortunately, the expert outlook for inflation and mortgage rates is that both should become more favorable over the course of the year. As Danielle Hale, chief economist at Realtor.com, says, quote, mortgage rates will continue to ease in 2024 as inflation improves, unquote. There's even talk the Fed may actually cut the Fed funds rate this year because inflation is cooling, even though it's not yet back to their ideal target. 10-year Treasury yield. Additionally, mortgage companies look at the 10-year Treasury yield to decide how much interest to charge on home loans. If the yield goes up, mortgage rates usually go up too. The opposite is also true, according to Investopedia, quote. One frequently used government bond benchmark to which mortgage lenders often peg their interest rates is the 10-year Treasury bond yield, unquote. Historically, the spread between the 10-year yield and the 30-year fixed-rate mortgage has been fairly consistent, but that's not the case recently. That means there's room for mortgage rates to come down, so keep an eye on which way the Treasury yield is trending and give you expert an idea of where mortgage rates may be headed. Bottom line, with the Fed meeting later this week, like today and tomorrow. Actually, I think if they come out with their statement tomorrow. Today's Tuesday, I think. With the Fed meeting later this week, experts in the industry will be keeping a close watch to see what they decide and what impact it'll have on the economy. To navigate any mortgage rate changes and their impact on your moving plans, it's best to have a team of professionals on your side. If you want to build that team, give me a call, 800-306-1990, 800-306-1990. That is the Real-Time Real Estate segment brought to you by rsrmoney.com, rsrmoney.com.